Hello, I'm Austin Schaul, Head of Research with Avantax. Today we will provide a market update for August. We'll start with a recap of returns for July and then shift to an update on the economy, earnings, AI spending, and our outlook going forward. July marked another robust month for stocks here in the U.S., driven by renewed risk appetite across the board. The S&P 500 marched steadily higher in July, carving out new all-time highs along the way, and ultimately finishing the month higher by more than 2%. Small cap stocks had a strong month as well, as the Russell 2000 tacked on about 1.75%. Overseas, international developed markets lost some momentum after a very strong first half of the year. The International Developed Index was lower by negative 1.4%. A strong month for stocks in China helped push emerging markets higher, as the MSCI EM index finished July higher by more than 2%. Year-to-date, international markets continue to outpace U.S. markets, as both the EFI and EM indices are higher by about 18%, while the S&P 500 is higher by about 9%. The month of July saw interest rates move marginally higher against the backdrop of a more hawkish Federal Reserve. This led to slightly negative returns for both taxable and municipal bond investors during the month of July. We've seen the gap between taxable and municipal bonds persist in recent weeks, as the taxable bond index is higher by nearly 4% on the year, while the municipal index is lower by about 0.5%. With the yield on the municipal bond index currently around 4%, we continue to view this weakness in municipal bonds as an attractive entry point for taxable investors, as supply and demand dynamics are expected to normalize in the months ahead. July gave investors plenty to digest in the form of several key economic indicators alongside a plethora of corporate earnings results. On the economic front, we got the first estimate of real GDP growth for the second quarter, which showed that the U.S. economy expanded at an annualized rate of 3% after posting negative growth in the first quarter. The negative print in Q1 was skewed lower due to a massive front-running of imports ahead of tariffs, and we saw that normalize in the second quarter, boosting GDP growth. As this chart shows, a decrease in net imports added nearly 5% to GDP during the quarter. While on the surface the report was strong, consumer spending added just 1% to the GDP number, reflecting a continuing trend of slower consumption. Elsewhere, the Fed's preferred measure of inflation, the core PCE price index, came in higher than expected at 2.8% year over year. Despite pressures from the White House, above-target inflation, paired with a stable economy, has kept the Federal Reserve on hold with interest rates. With just 3 policy-setting meetings remaining this year, we expect to see 2 or 3 25 basis point rate cuts, with the first coming as early as the next meeting on September 17th. Earnings season is well underway as we move into the month of August, and thus far, the results have been quite strong. With a little over half of S&P 500 companies having reported results, the index is on track to post earnings growth of nearly 8%, well above estimates heading into the quarter. The technology and communications sectors have been the largest contributors to earnings growth to date, highlighting the relentless CapEx spending from the artificial intelligence hyperscalers. The left chart shows investment spending by 4 major AI hyperscalers here in the U.S., which has increased in recent years and is expected to continue rising in the years ahead. The right-hand side shows the latest trends in AI business adoption in the U.S., where adoption is still in the early stages and persistent across all sectors. Earnings call commentary from corporate executives continues to point towards increasing spending on artificial intelligence with no signs of slowing. This could help support otherwise lofty valuations within the equity markets. As we close out July, the markets continue to reflect a complex but resilient landscape. The economic outlook remains nuanced, with signals of strength and others of caution. The markets have calmed down considerably from earlier this spring, but we expect to see higher volatility in the months ahead as investors adjust to potentially higher for longer interest rates, trade policy, and elevated equity market valuations amid a slowing economic backdrop. While uncertainties do remain, we continue to believe that opportunities persist for those who stay disciplined and focused on the long term. That's what we have for this month. Thank you for watching and have a great day.